Happy Monday morning. I'm Morella Fernandez. Welcome to Market Call. Jordan Zinberg on the show today, President and CEO at Bedford Park Capital, and he's going to take your questions on Canadian small and mid-cap stocks. Here's how to reach us, 1-855-326-6266 if you want to phone in. You can also email your questions, marketcall@bnnbloomberg.ca. Jordan, thanks very much for coming in. As you know, our Prime Minister will meet the American president, which is a good thing. Do you think this will sort of shake out some of the uncertainty that we've seen in the markets at the start of the year?
I think it'll definitely help, and I think we're already seeing some stability in the markets. February and March was a pretty rough go for investors. We went on a bit of a wild ride, but I am seeing fundamental buyers stepping in. I think valuations are still really attractive, and I think as long as we can solve this tariff issue relatively quickly, I think the setup for investors is very good from here.
Are you, or you have been advising investors, I guess, to take a look at their tariff exposure? What are you asking them to look for? What do they look for?
Sure. So what we did when this started was we did a position-by-position review. And really what I was looking for was two things. I wanted to know direct exposure to tariffs, so a company that's making a product in Canada, let's say, that's selling into the U.S. And then I wanted to look at things like indirect impacts. So we had some companies, let's say, that were service companies or maybe a lending business. And in the case of a lending business, let's use that as an example, there may not be direct tariff impact. They're not making a product that they're selling in another geography. But you can have impacts like unemployment, let's say. So if we see a spike in unemployment, that would lead to decreased credit performance. So that would be a more indirect. So I think investors have to really go through their portfolio or any names they're looking at and really critically analyze both direct and indirect impact. And right now, given that there's so many good opportunities in the market, I don't think you really need to hold a stock where you're unsure what the impact will be or you think there will be significant impact to margins. I think there's enough companies out there that if you dig through, you don't need to hold stocks like that right now.
Okay, so let's talk a little bit about if Canada gets shaken out with the U.S. through this meeting and something sort of comes to fruition sooner than later. Mm-hmm. But China, for example, or parts of Asia are still under certain tariff concerns. What do you think the year will look like for investors moving forward? Or is it so dependent on sort of what else happens in the rest of the world?
I think investors need to be really, and this is our approach, is looking from a bottom-up perspective, meaning looking company by company. I'm not a macro investor. I'm not going to predict what's going to happen with tariffs or rates or anything like that. I'm going to look at the companies individually on their own. I'm going to look at the company fundamentals, and I'm going to pick my spots.
Okay, so would you recommend to people who you're advising to kind of stick in North America at this point? Some people are saying look to Europe or other markets to invest.
I'm probably not the best person to answer that question because we focus exclusively on Canada. And I can tell you within the Canadian market and within the universe that we follow, I'm finding tons of growth stocks on single-digit multiples. And when you can buy stocks like that, the setup's very good.
Okay. We will take a quick break. We'll line up some of the phone calls for you for when we get back. Jordan Zinberg is President and CEO at Bedford Park Capital, taking your question on Canadian small and mid-cap stocks. We're back in a moment. Welcome back to Market Call. We are going straight to your questions. Kevin has emailed in and says, what are your guests' thoughts on Searia for the next 2 years? They make mobility equipment, so you think there's a growing market there?
There's absolutely a growing market there. So they make things like in-home stair lifts, in-home elevators, things like that. I've been following the company for many years, haven't owned it for quite a while. This is one that has traded sideways probably for about the last 4 or 5 years, if you look at a longer-term chart. And it did get hit pretty hard in February and March with all the tariff news. And the reason for that is a lot of their production is in Canada and China, and the products are sold into the U.S. So I have seen some research lately that the company is working quickly to try to move some production to the U.S. That they can sell directly, so they can probably absorb some of the tariff impact. But I think this is one, going back to our conversation off the top, that I think you need to be careful with. And until you have a really good handle on tariff impact, I think there's other places you want to look, because the growth rate is decent on Searia, but it's not outstanding. And I think you'll find throughout the course of the show today, I'll point out some names that you'll probably be better off in than this one.
Got it. Okay, let's go to the phone lines. And John's on the line from London, Ontario. Hi, John.
Hi, Morella. Hello, Jordan. Jordan, McCoy Global is an interesting stock. I bought it, and I'm above water on it. It had a spike recently on news before giving about a quarter to a third of that back. What do you think of tariffs, and what do you think of McCoy and profitability? Thanks very much.
Can you tell us a little bit about McCoy?
Sure. So McCoy is an energy services company. They specialize primarily in technology to improve safety down when they're digging, so worker safety, things like that. They've got a new product that they came out with recently, and that was part of the excitement. If you look at the chart about a week or two ago, you'll see the stock popped about 25%. That's what the caller was alluding to. They've got some technology that allows energy companies to actually monitor progress remotely from anywhere in the world. And the reason that's significant is it also is going to lead to some recurring revenue for the company, which you don't usually see with energy services businesses. Typically, they're selling a product or they're on a site and they do a job and they're finished. So I think that's one of the things that excited me. Regular viewers will know I actually top picked McCoy probably about a year ago, maybe less than that, around $2. So I definitely do like the stock. We do own it in our portfolio. We've held it for since that $2 level. I think 2025 will be a good year for the company, but they're still testing this new product and they're still rolling it out. So I think the pivotal year for McCoy is actually going to be 2026. So if you're able to hold on and have kind of a 2-year time frame, I think you're going to do extremely well with McCoy. Not only that, it's still trading on only about 6 times earnings, which for a company that's profitable, it's got a great balance sheet, it's well run. I sat down with management about a week ago. Everything's going extremely well there. So I think you're on the right track with this one. I would continue to hold it.
And just so I understand, the technology you think is something that other companies will be able to use, and so they'll be able to provide that for a fee?
Yeah, and not only that, it actually cuts costs, so they need less workers. So it's cutting costs and improving safety, which for mining companies, if you can show them lower costs and improve safeties for mining and energy companies, excellent.
Got it. Okay, let's go back to the phone lines. Mike is on the line calling from Toronto. Hi, Mike.
Hi, I'd like to ask about Source Energy. It's pulled back a lot. Do you think this is a good place to add to lower the average cost base, or should I move into something else? Thank you.
Okay, so let's turn to Source Energy. We'll pull that chart up now. Go ahead.
Sure. Source Energy, Mike, I don't know if you know, this is one of my favorites. I've been talking about it on the show for a couple of years now, since I think the first top pick was around that $1.50 or $2 level. So we've had a great pass on the stock. As you alluded to, it has come off significantly along with the rest of the energy services names. Source is a little bit different in that, for those who don't know it, they're not actually providing equipment or services. What they're providing is frac sand. So they're the leading provider of frac sand in Western Canada. It did come off due to tariff concerns. They are mining the sand in Wisconsin and bringing it up from Wisconsin into Western Canada. They've applied for an exemption on the tariff side. I think there's a couple things to look at here. First, the stock is extremely cheap. It's trading on about 2 times EBITDA, so well below the group. Because it's such a strategic asset as well, I think it could be a takeover target. So we've got a cheap stock with a very highly profitable strategic business. I would buy it here if we didn't already own so much. So if you bought it higher and you want to average down, go right ahead. But we love Source. I think the stock's probably worth at least $18 to $20 over the next year or so.
Got it. Okay, let's go back to an email then. Frank is emailed in. He said, can I have the guest thoughts on Aritzia? Aritzia has been in the news a lot, as you know. They just reported earnings. It did quadruple the business in the quarter, the latest quarter, than they did a quarter ago. And it's a company people have questions about because they weren't sure how much was sourced from Asia or China, and they seem to have put those concerns to rest. But I'm sure people are still wanting to know what the future holds. What's your take on Aritzia?
Sure. So let's start with the positives. As you alluded to, they had a monster Q4, really impressive Q4. The stock ran. You can see it in the chart if you look at it recently. Not only that, they have a very strong brand, I would say. And then the third point is their U.S. expansion is going extremely well. As far as I know, they're getting a payback on stores of less than 1 year, which in retail is fantastic. So those are the positives. I think on the negative side, as you alluded to, some tariff impact due to where they source their products. And I think people are still evaluating that right now. It's a stock I've actually wanted to own many times over the years. It's just always traded at a bit of a premium multiple, I think, because of the brand awareness and things like that. So I think it's an outstanding company. I think long-term it'll do really well. You may need to just, again, going back to where we started off the top, just get a real handle on the tariff impact before you step in. But I think it's a very high-quality company, and the financials are excellent. Any
concern about consumer spending being reined in the rest of the year and that affecting sort of women buying clothing?
Absolutely. Again, I'm not an expert on women's clothing, but looking at the numbers, they're obviously doing a lot of things right. We don't actually own any consumer stocks right now. And that's not really a macro call. It's just that when I look at the opportunity set across all sectors, consumer is just not an area where I've really found anything I've wanted to buy. But if I was going to buy anything in the sector, this is one that I would be taking a hard look at.
Got it. Okay, let's take a quick break. We'll line up more of your phone calls. Jordan Zinberg with us, President, CEO at Bedford Park Capital. We're back in a moment. Welcome back to Market Call. Let's go to an email from Debbie. Debbie says, is MDA space a good medium to long-term hold? They've been up and down at the end of last week with another announcement by Donald Trump saying he's going to consider gutting NASA spending, more than $4 billion. And there were concerns that would affect MDA. What's your take on MDA generally speaking?
Sure. So let's start with Friday. So Friday, NASA came out with a new budget. They cut funding for a lot of space programs. That is a significant impact on MDA. That's a big customer of theirs. I've been watching this stock for a while. It's been on my radar. They've announced some really impressive contract wins. And as you know, the sector itself has been quite hot with Elon Musk and everything else that's been going on. And it's one of the only direct ways for Canadian investors who are investing in our domestic market to play this sector. Having said that, I've invested in a lot of companies in the past that are dependent on governments, and I've been burned before. So this is one where I'm watching it. The numbers look good. Revenue is growing pretty quickly. They've announced some major contract wins, but I think you need to be careful, again, just because of the sector they're in. So it's on my radar. The growth is impressive. I just haven't felt like I need to own it just yet. Do
they do a lot of business with the U.S. government? I know they do the lower orbit satellites. I'm just wondering, do they rely on the U.S. for a lot of their business, or do they have some in Canada as well?
They've got other customers, but obviously NASA, if you're in that sector, is going to be a big customer. And if they're cutting spending, that's definitely a concern. So I think it's a name of interest for me, but not something I'm ready to buy yet. And I think I also just need to get a little bit smarter on the sector in general. It's not a sector where I've done a lot of investing before.
Got it. Okay, let's go back to the phone lines. Mike's on the line from Toronto. Hi, Mike.
Guys, would like to keep it short for you, so all your thoughts on Avante Corp would be much appreciated.
Okay, thanks for the question.
Sure. Avante. So it's a security company. They do offer high-end home security. People who live in Toronto might have seen their cars driving around. They'll offer monthly service for homeowners where they'll come and check on your home and make sure your car doors are locked and your home is locked and things like that. I think a couple interesting things here. The first is the original founder recently stepped back in as CEO. They had a CEO in there for about 4 years, and the stock didn't really do very well over that time frame. The traditional security business itself, where you're supplying security guards, is not a great business. You know, you're supplying a guard, let's say, at $20 and billing them out at $24. You've got to do a lot of volume. Where the company's expanded recently, and I think this is where it might get some investors' attention, is they've started to produce security towers. And there's another business called Zedcor in Canada that's done extremely well lately that's in that business. And Avante actually pulled over one of Zedcor's employees recently. So I think they're going to make a big push into this tower security business. So think of a tower with lights and a camera on it that can be used to surveil things like big box retail parking lots or construction sites. So places where you would have had to have 1 or 2 security guards before at 40 or 50 bucks an hour combined, where you can now place a tower there at a much lower cost that's then monitored remotely. So it's actually a very unique business, and Avante's trying to break into that business. So I think if they're successful there, the stock will do very well. I think as it stands right now on its own, it's not something that I'm willing to step into, but I'm watching closely to see how their tower security business goes.
Got it. Okay. Let's go to the phone line for Tammy. Tammy's on the line from Ottawa with her question. Hi, Tammy. Tammy, you there?
Yes. I just wanted to get Jordan's thoughts on VHI valuation and if he would be buying it at these prices.
Okay. Thank you for the question.
Sure. So VitalHub, for those who aren't familiar, they are a growth by acquisition business that tends to buy companies that produce software for hospitals that improves things like patient flow and efficiency in hospitals. This is one that I was really early on. I think I started buying it somewhere in that kind of $1.50 level quite a long time ago. Sold it too early. It's done extremely well. I think the valuation now is a bit of a premium multiple, and I think, to be quite honest, the company deserves it. Management's done a really good job with this business. Probably not something I would step into now, only because of valuation. Nothing at all wrong with the business, but if you're okay paying up a little bit and allowing the company to backfill that valuation and grow into that valuation, I think you'll still continue to do well with this one over time. It's a favorite amongst investors. They have no problem raising capital, and management's shown they can do a really good job with acquisition. So great name, little pricey. I don't currently own it, but a lot of respect for the management team.
Yeah, it went down to sort of something like $8.60 at the start of the year, and now it's back up to $11.60. So the time to buy would have been, I guess, in that dip when everything else got taken down.
Well, everything's clear in hindsight,
Sure,
right?
of course.
Yeah.
But you'd still buy in it, or tell people they'd be comfortable to buy in at $11.60 if they're going to hold it long term?
Yeah, I think you really have to make sure you're okay with them backfilling that valuation, because the stock is a little bit pricey. But like I said, it's a high quality business and they deserve the valuation right now.
Got it. Okay, let's go back to the phone lines. Joseph is on the line from Montreal. Hi, Joseph.
Good day, friends. Just want to get your opinion on Knight Therapeutics. The company seems to be slowly but steadily growing year over year, outpacing some of its peers in certain regards, keeping up with them and others. And I see it showed up on one of my technical screeners as possibly a good buy right now. So I want to get your opinion on Knight Therapeutics. Thanks in advance.
Okay, so Knight Therapeutics is pharmaceuticals, I guess.
Yep.
And do you like them?
I've looked at it a few times. The reason I've looked at it is it's a run, or was originally started by a gentleman named Jonathan Goodman, who about 15 years ago had a Canadian public company in Canada called Paladin Labs.
Okay.
And they did ostensibly the same thing that Knight has done, although he hasn't really been able to replicate his success with Knight. Interestingly, he just bought back the Paladin business that he sold many years ago, and it's been folded back into Knight. So we'll see if that makes a bit of a difference now. I've looked at the numbers. The numbers are okay. They're not fantastic. I think there are probably better names in that sector if you want to be in that sector. But again, a lot of respect for the management team. And if they were able to get back to what they were doing 10 or 15 years ago, and I don't know if the market will actually allow that now, they were basically buying rights to older drugs, distribution rights in countries that Big Pharma didn't care about. So let's say you had a Big Pharma that had a drug they were distributing in the major markets. They would go to them and say, give us the rights to Canada, give us the rights to Israel, give us the rights to some of these smaller countries. And it was a fantastic business. It did extremely well. And I did own it back then. So a lot of respect for Jonathan and Searia and the rest of the team. Numbers aren't quite there for me right now.
Got it. Okay, back to the phone lines. Carl's on the line from Toronto. Hi, Carl.
Hi, Morella. Thanks for taking my call. Jordan, I'm calling today about Bird Construction. I realize that the industrial sector has been, seriously struggling lately because of the threat of tariffs. But in the case of Bird, its stock price fell over 40% from back in October, when I believe you had it as a top pick, until the end of April, which seems a little extreme to me. At any rate, about 3 weeks or so ago, they announced that they had been awarded 5 projects worth about $650 million. The stock price has started to turn around, which is great. And so I would appreciate your views of where we stand now, and were you picking any up on the bargain price, and how are we going to make out down the road? Thank you very much.
Okay, thanks for your question. Just wondering, why were they so dramatically on that downward slide at the end of last year?
I think it was a case of several companies that got hit. I can't speak to anything specific with Bird. I still really like the business. The numbers are fantastic. I think within the industrials, and more specifically that engineering and construction space where you have other names like Aecon, for example, I think this is really the one you want to own. We continue to own it. I haven't added to the position only because those who know me well know that I typically like to add to stocks as they're going higher. So I don't try to buy stocks when they're lower. I try to buy them as they're working, and I try to add capital to the names that are working best for me. This one hasn't really worked, but the numbers are spectacular. So we've continued to hold our position. I think this is the top name in that space. I would continue to hold it. The stock's trading on something like 6 or 7 times earnings with a return on capital north of 20% every year. Management is excellent. As the caller alluded to, they've continued to win large contracts and continue to announce these large contract wins consistently. So I think this was one where the whole sector just kind of sold off. I don't think this was anything Bird specific. I think people were concerned about economic slowdowns and the stock sold off. But I'm continuing to hold the stock, and I would encourage the caller to continue to hold the stock as well.
Got it. Okay, we are going to take a quick break. When we come back, we'll have a look at Jordan's past picks. Back in a moment. Welcome Back to Market Call. Let's go to past picks for Jordan. He is here at the desk to take a look with us. These are his past picks from April 8th of last year, and at the time he picked Go Easy. Go Easy on the TSX recommended at $169, now at $159.96. So 5% drop return, a 2% drop in total return. They provide loans essentially to people who have credit history problems. Do you remember why you liked them last year?
The same reason I like them now. Go Easy is, in my mind, one of the best non-bank financials in Canada. As you alluded to, they're a non-prime lender, so they offer loans and lines of credit. They've expanded into auto loans. They're actually just now expanding into credit cards. So a really solid company. I actually just did a full write-up on Go Easy in our recent investor letter, and I'm going to throw some numbers at you now, which I think will tell you why I like this stock so much. Over the last 10 years, the earnings per share have gone from $2 to $20. And the stock has returned 25% annually to investors over 10 years, including dividends. So one of the best performing stocks in Canada. The problem with this name is that a lot of people don't understand it. So it's a volatile stock. And in order to capture those returns that I just alluded to, you really need to have the stomach to hold it. So over the last 10 years, you've gotten that 25% annual return. You've had the stock drop 50% or more once, and you've had the stock drop 25% or more several times. So you really need to be able to hold this through the cycle, because what happens is anytime people get worried about the economy, they tend to get worried about the non-prime lenders because they worry about unemployment spiking. What they don't realize is that when we get into a tough economy, that's actually the best time to buy these names, because what happens is the banks tighten their credit and you get these better quality borrowers that could have gone to a bank before that now slip down into lenders like Go Easy. So you actually get the best credits in that time frame. The stock at these levels is extremely cheap. It's trading on 7 times earnings. The long-term average is 10 times earnings. So if you look at analyst estimates, they're about $22 of EPS. If you put a 10 times multiple on that, that's $220. That's about a 50% move from where we are now. So I know I picked it a year ago and it didn't work, but I think you're still gonna, a year from now, you're gonna see this stock materially higher.
Got it. Okay, let's get to your second pick from last April, which was Enterprise Group. Let's get to the numbers. Enterprise at the time was recommended at $1.23, now up to $1.48, so a 20% upside return and a 20% total return. Moving forward, do you still like Enterprise?
Yes, I do. And actually what caught my attention was with Enterprise, they're an energy services company and they're relatively small, but they've got a very fast-growing power division. And what they do is they supply natural gas turbines to customers that are used to power drilling sites. So think of a site that would traditionally be powered by a diesel generator, which is expensive and obviously not environmentally friendly. And you can now supply with natural gas. And some of these sites even have natural gas on site. So it's very, very easy. Notably, the company announced a very large, well, large for them, acquisition last week. It was a $20 million deal. They bought the Canadian business of Flex Energy. That's the company that actually manufactures the turbines. So before they were buying units from them, they've now bought the Canadian business. It included 17 turbines that are already out in the field. I think the company will be able to redeploy those turbines over time at higher rates. So very strategic deal. Not a very well-known company. I think there's a lot of upside. I see a pathway to $100 million in revenue over the next 3 to 5 years. Management team's a little older. I wouldn't be surprised if we see this thing get taken out before the next energy cycle.
And also with that dip, again, from the start of the year, good time to buy in now?
Yeah, they didn't do a very good job communicating their results later in the last year to the street. So I think there was some disappointment around their Q3 and Q4 earnings specifically. The flip side is, as I said, they've just announced this acquisition, and I think going forward, there's tremendous upside in the stock, so we continue to hold it.
Okay, let's get to your third pick from last April then, which is Topicus. And at the time, it was $124, now $162.55. So a 31% upside return and a 31% total return, and they're a software company.
Yeah, they're a vertical market software business that was spun out of Constellation Software, which I'm sure many of the viewers know pretty well. The spinoff, Topicus, is not as well known. It was essentially their European division that they spun out. So they're doing the exact same thing that Constellation does. Small acquisitions in vertical market, mission critical software. When I picked it last year, I actually remember at the time it had been lagging Constellation quite a bit, and I thought there was room for a catch-up trade, and that's actually happened. The stock's done very well over the past year. I think when you look at it now, you may want to rotate into Constellation or maybe some other names, because even though we still own the stock, it's had a big run here, and I think I have another name that we're going to talk about later on in top picks that I think would be an interesting one for those who might own this one if they may want to replace into something where you're going to get a little more upside.
That was very much, stay tuned for that coming up in about 20 minutes time. Jordan Zinberg with us, President and CEO of Bedford Park Capital. We are going to go back to your questions in a moment. We're back in a moment. Stay tuned. Welcome back. John has been holding on the line. He's calling from Saskatoon with his question today. Hi, John.
Hi, I'd like to ask about Main Street Equities. Do you still like it here? Thank you.
Thanks for the question. Main Street Equities.
Talked about this one many times on the show. John, the answer is yes. Probably like it even more now than I did a year ago. And the reason for that is the stock's gone kind of quiet in terms of share price. But operationally, the company continues to do extremely well. The last couple quarters have been excellent. For those who don't know the business, they're in the real estate business in mid-market apartments in Western Canada. So think of, $1,200 a month apartments in Alberta and BC. The CEO has done an incredible job. I actually just saw it's their 25th anniversary coming up soon. He's taken the stock from a couple dollars to $190, I think, where we are today.
195, yeah.
And he's done that with zero equity. He's raised zero equity. The CEO still owns half the company, so he's all in. I love founder-led businesses like that. We're still seeing very strong growth in rents, and we're still seeing very low vacancies. I have the net asset value at about $253 a share, I believe. So for a while, the company was trading at a premium to that net asset value. Now you're able to buy shares at a substantial discount. So it's one of the top positions in our fund. I think it's a great steady Eddie. I think it's a great long-term hold, a great sleep at night stock. So yes, the answer is yes. I would continue to own it. I would continue to buy it here.
Are they a dividend stock at all?
They have a very small dividend that they put in place only so that they could appeal to funds that need to buy stocks with dividends, like dividend-oriented stocks. But the key to this business is actually that it's much different than traditional real estate companies. So when you think of a normal REIT, they're paying out a lot of their cash flows as dividends, and that's why investors like to buy them. They've taken a different approach at Main Street. What they've done is they actually retain most of their cash flows, and they use that to buy more buildings. So that's why they haven't had to issue equity over the years in order to grow. They've been able to grow just by reinvesting their cash flows, and I love businesses like that, and that's why this is the only real estate stock I've ever bought.
Got it. Okay, let's go back to the phone line. Sylvain is on the line from Montreal. Hi, Sylvain. What's your question today?
Good afternoon. What is your outlook for AJ Growth International? Thank you.
Thank you.
Ag growth. We had a very small position last year, which I've now sold. I was a little bit frustrated with this one. The numbers were good, but they continue to have a lot of problems in their farm business. The company has two divisions. They've got a farm division and they've got a commercial division. The commercial division's been pretty strong. The farm business has been pretty weak. They're also active in a lot of different geographies, and some of those geographies have been weaker than others. Management took their guidance down. We saw a couple disappointing quarters. And again, going back to some of my comments at the beginning of the show, I think there are so many good opportunities now that to buy something that's had a couple bad quarters in a row and you may have some question marks about, it's just not worth it. So we had a very small position, sold it last year, made a small profit, and moved on.
Got it. Okay. Let's go back to the phones, and Sal's on the line. He's calling from Toronto. Hi, Sal.
Hi there. Yeah, my question was on Kraken Robotics. I was interested in looking at a defense play in Canada, and this is one that came up. I was wondering if it would be a good time to enter into a position, understanding that its valuation might be on the high end. Looking forward to your thoughts. Thanks so much.
Okay, so let's pull up the chart for Kraken Robotics. What do they do?
It's a really neat business, actually. They do, think of things like drones that will go deep sea. So there's, Navy customers, things of that nature. They've got some really cool products. We were actually early into this one. I think I bought the stock first around 50 or 55 cents, probably about 6 or 7 years ago now. and we had a good run. We did well with the stock. There was CEO turnover a couple of years ago, and Greg, the new CEO, who was formerly the CFO, has done an outstanding job. We have been in and out of the stock. I don't own it right now because, as Adam alluded to, the valuation is at a premium right now. This is another one, going back to our conversation on MDA, where you're dealing with governments, you're dealing with contracts that can take a very long time, but when they do win them, they're large. So I think it's a good name. If you want exposure to this space, there's not a lot of ways to get them. You just have to kind of stomach that valuation, and I'm not willing to pay up for the name right now. So we were in early, we were out early, we've been in and out a few times, but my concern here would only be valuation.
Got it. All right, let's go back to an email. This is from Adam. Adam says, curious what Jordan thinks of 5N Plus. Is this a good place to add? So we'll take a look at 5N Plus right now.
Yeah, 5N Plus, I'm guessing, is not very well known, so I'll maybe just explain what they do. They're based in Montreal, and they supply specialty semiconductors and performance materials. So think of customers like a solar panel manufacturer, for example. And that's actually one of the reasons why the stock has dipped a bit lately. There's a company in the US, relatively large, called First Solar, who recently came out and brought their guidance down. I believe they are one of 5N Plus's biggest customers, if not the biggest. So I think there were some concerns there. This is another one where I think you really have to get a good handle on tariff impact, which I don't have with this name specifically. The stock's done pretty well over the last several years. It's always been one of those where the growth has been okay, but not really growthy enough for me. So I think when you combine that sort of average growth profile with some tariff impact that I'm not sure about, it isn't really something I'd want to step into right now. But I think if the investor has a good handle on tariffs and is comfortable, then it can be something to look at.
It's one to watch sort of after the tariff threat is over.
Yeah, and when your big customers are reducing guidance, that's always a concern as well.
Got it. Okay, we are going to take a quick break. We're going to be back to answer more of your questions in just a moment. Stay tuned. Welcome back to Market Call. Let's get to an email from Bill. He says, how do you feel about adding to Leon's Furniture at the current pricing? This is an interesting one. Again, with a lot of consumer sentiment slowing down, people don't want to buy as much. If you're buying furniture, it's pretty much a bigger investment. Would you recommend going into something like Leon's Furniture at this point?
I'm almost going to answer Bill's question with a question, which I know you don't want, which is, how do you feel about the consumer? Because as you said, this is based on sentiment. This is based on consumers' comfort with going and buying those big ticket items. Leon's done quite well over the years, and they're a dominant player in Canada. What I'm looking for when I'm looking at companies is companies that I think can grow at 20% a year or more. And where I've always struggled with Leon's is the idea that they can sell 20% more beds and couches and furniture and all those things. They've done a great job. The stock's done well. It's a conservative choice. But based on the sector alone and the products that they sell, it's probably not something that I'd be looking to buy right now. As I mentioned earlier, really not that excited about anything in the consumer sector right now.
I think he's liking the fact that it's dropped, like many stocks, and maybe it's a good time to pick it up for a good price. But who knows how long sort of the overhang of consumer sentiment will be, right?
Absolutely. And just because stocks have dropped actually doesn't mean it's a good time to buy them. Often it means there's information or opinions in the market that you may not be aware of. So usually, again, going back to what I was talking about before, I'd rather buy a stock as it's moving higher than, let's say, buy a stock at 10, it falls to 8, and you think, oh, it's a great deal at 8, and you go and buy it at 8, and then it trades between 8 and 9 for 2 years, and you have a bunch of your capital in this stock that's dead. So I'd rather be buying a stock that's going from 10 to 12 to 14 and adding my capital to the names that are actually working in my portfolio.
All right, let's go to the phone lines. Kat's on the line from North Bay, Ontario. Hi, Kat.
Hi, thanks for taking my call. I'd just like your opinion on Foro International, please.
Okay, thank you for the question.
Sure. Foro is a mining services business. They also have a rapidly growing water treatment division as well. So I was pretty excited about this one probably about a year and a half ago. Very well run, nice clean balance sheet. And then we bought some stock and the company missed a couple quarters, which, I think when you have a company that's missing several quarters in a row, you need to really look at that, and I did. And the problem was that a lot of the junior miners had reduced activity. Foraco's year-over-year comps weren't great. Now, in fairness, they were exiting a few geographies, so they were winning new business, but they were exiting some old business. So when you looked at the numbers, they looked relatively flat or even down. And I think we've seen a couple disappointing quarters. Tim, the CEO, has done a great job. We don't own the stock currently. Did sell it a bit higher. Again, it was one of those situations where when the market was falling, I was trying to make sure we had our money in our best ideas only. And when I looked at Foraco, given the environment in junior miners, although the financings have picked up, I think we've probably seen the trough for Foraco. I think maybe one more disappointing quarter, maybe not, but drilling activity is picking up. We've seen a lot of the junior mining companies raising money. So I do think if you can wait another quarter or two, the stock may start to rebound. I've chosen to just move into some other names instead.
Got it. Let's go back to the phone lines. Brian's calling from Ottawa today. Hi, Brian.
Hello. My question today is about Well Health Technologies, ticker WELL. I'm going to preface my question by asking you, Morella, if you can provide analyst recommendations and the price target. And the reason why I'm asking that is because unless things are changed, my understanding is that analysts seem to really favor this stock and have a very high price target, could be even double where the price is currently at. I've been watching this stock for a few years. When they report their quarterly earnings, their metrics seem to continually improve in terms of patient visits, revenue, et cetera. But often the stock sells off significantly on that news. And it seems to me the stock's mired in the $3 and $4 range, whereas the price target has been up in the $8 and $9 range. It can never get up there or stay up there. So I'm wondering if I'm missing something or if you have any insight on the company and what you think about it. Thank you.
Okay, so let's talk about Well Health. They run clinics, I guess, medical clinics, walk-in clinics, that kind of thing. Do you see any specific overhang for Well Health that's keeping them sort of subdued?
I think the expectations on this name have been high from the beginning. So the founder had a business previously that was well known to Canadian investors that lots of people did well on. So when, pardon the pun, when he started well, I think a lot of people stepped in just on that basis. I first saw the company very early on. At that point, I think they owned 4 doctors' offices and that was it. And even at that time, going to your comments, Brian, even at that time, the company was expensive. I think it was something like a 50 or 60 million market cap for 4 doctors' offices, which I thought was ridiculous. Now, obviously, people were paying up for growth and people continue to pay up for growth, but the business has changed over time. Originally, it was more of a digital business, an online health business, which during COVID obviously did very well. If you go to a longer-term chart, you'll see during COVID there was a huge spike. And to your point, Brian, they've done a really good job growing the business. Where they've lagged a little bit is on profitability. And that's where I think the issue has been, where every quarter, the revenue growth is there, but the profitability is not there. And one of the reasons that analysts seem to love this stock so much is the company does raise money quite often. So from an investment banking perspective, it's a very good client for investment banks. They do raise money frequently. Analysts are generally positive on it for that reason. So it's not a bad business, but in order to backfill their valuation, they really need to step up their profitability, and we just haven't seen that yet.
Okay. As you mentioned, we did see that spike during COVID, and then it kind of has tapered off again, so that was their big winning time. Okay, let's go back to Sam, who's on the line now. He's calling from Toronto. Hi, Sam.
Hi, I'm inquiring about the Kids Eye Care. Do you think it's a buy at this price, and do you have any target price? I'd appreciate your opinion. Thank you.
Thanks
Bye.
for the call. Kids Eye Care.
This is a really neat business. I actually bought this one pretty early on. For those who aren't familiar with it, they do glasses and contacts, but online. So no physical stores. They've done a very good job growing the business. The CEO had an eyeglass business previously that was sold to private equity. It was public. I can't remember the name off the top of my head right now. But these are veterans of the industry, and I love the model, and that's why I bought the stock originally. They were a little slow with growth coming out of the gates, although they seem to have hit their stride now. The big comp is usually Warby Parker out of the US. Some viewers might be familiar with that company. And the thesis on Kits was always that it was trading at a huge discount to Warby Parker. What's happened now is that Kit's valuation has gone up slightly and Warby Parker's valuation has come down. So they're trading more in line. So I think there's been a big move in the stock and they have made some great strides. We don't own it currently. It is on the radar screen. We did own it. I think I probably sold it about 2 or 3 years ago. So I was a little bit early on the sale. And sometimes that's not a horrible thing. Sometimes you want to get in early and get out early and own it before it has that sort of pristine valuation. But the stock's done extremely well, and I think the company will continue to grow, and I think profitability will improve. So don't own it, but am watching it.
Got it. Okay, that was Kids Eye Care. That is all the time we have for your phone calls and your emails today. But stick around. Top picks are coming up next. Welcome back. Time now for Jordan's top picks. His first one right now is Propel Holdings, PRL, on the TSX. Tell me why you like Propel. And this is one of the lenders, I guess, online lenders that also provides to people who might have difficulty getting money from a bank.
Exactly. So another non-prime lender. This pick shouldn't surprise anyone. This has been a long-term favorite of mine, and I've top picked it in the past. I didn't get a chance to top pick it recently because the stock was just moving higher and higher and higher. So I'm glad I get to top pick it again. They provide loans and lines of credit to customers mostly in the US, but they do have a Canadian division, and then they recently did an acquisition in the UK as well. Probably the biggest news here was last week they announced that they refinanced their debt at a substantially lower rate, and they also upsized it. So they have more firepower now at a lower rate, which is fantastic. I think this, and I've said this before, this stock gives you everything. It gives you growth, it gives you a nice dividend, and it's trading at 7 times earnings, which is fantastic for a company. I think consensus growth for Q1 from analysts is 40%. So you've got a company that's growing 40, 50% a year, trading on 7 times earnings, extremely well run. Management owns a ton of stock. This one checks all the boxes. For me, it's a must own.
And just as we talked about, with the worry of recession that has been talked about across North America with some of what Donald Trump is doing with the trade war, is this a company that could do well in those circumstances, or is this a company you're worried about because people might not pay back their loans?
Well, they do have a substantial portion of loans that don't get paid back. That's just a function of the business that they're in. The way that they compensate for that is by charging higher interest rates. So lending is all about spread. It's about the spread between what you charge in your interest rate, minus your operating costs, minus your charge-offs, taxes. That gives you your profits. So as long as there's enough spread, that's fine. But going back to what we talked about earlier, they are picking up better credits and higher quality borrowers. Not worried about this stock at all. It's growing like crazy.
Got it. Okay, let's get to your second pick, which is Lumen Group, LMN, on the TSX. Let's talk about this software provider. What kind of software do they provide? How valuable is it to the people they provide it to?
It's extremely valuable. It's mission critical software. So this is another spin out from Constellation. So we talked about Topicus in my past picks. This is the same setup, but with the other spin out. So last year when I picked Topicus, that one was lagging. Now I'm picking Lumen. This one is lagging. I think the reason it's lagging is important to understand. There's been a bit of a slowdown in M&A on this name. So I think as soon as that picks up, you're going to see the stock re-rate higher. It's been lagging Constellation and Topicus a little bit over the past year, but I do think it's going to catch up. They tend to do bigger deals than Constellation and Topicus. So when they do make an acquisition, it'll be a bit of a bigger splash. Very high quality business, similar financial profile to both Constellation and Topicus. So you'd think they would trade as a group, but I watch all three very closely, and I like to try to pick spots and sort of vary my exposure based on how well they're doing and where the valuations are. So I think Lumen is in pecking order between the three, the one that you want to own right now.
And you said there's been lagging in M&A just generally, or for them, you mean?
For them specifically. So they did a couple big deals, but over the past, I think their last deal was probably about 4 or 5 months ago. So this is one where they announce a big deal, investors get excited, the stock re-rates, then it tends to go quiet unless we have a surprise on a quarter or something like that. But I do think they're due for a big deal.
Got it. Okay, let's get to your last pick. For your forward pick is NTG Clarity, NCI on the TSX. They're also IT solutions. Tell me who their customers are. Tell me what kind of solutions they provide.
So it's an IT services business, and I know we don't have a ton of time, so I think the quickest way to explain it would be to call it a baby CGI. I think a lot of Canadian investors are familiar with CGI. So think of a baby CGI that's based in Toronto, but in fact provides services primarily in the Middle East and in fact mostly in Saudi Arabia. So they're providing services to a diversified customer base. Once in a while, I like to come with a top pick that I think the viewers haven't heard of. This company is a sub 100 million market cap. They're growing their top line extremely fast. They're profitable. They have a nice balance sheet. Not well known to investors. There's only one analyst covering it now. I think that's going to change. I think over time you're going to see this stock continue to move higher as awareness grows. I think the valuation will expand.
Okay. We have a couple more minutes, so I just wanted to ask you if you had any more general advice for consumers in what is a kind of very odd time, right? Where the markets have really dropped down for a couple of months. Now we're seeing some, I'm going to say stability. It's probably not the right word, but we're not seeing any major big market moving announcements out of Washington every day or every hour like we did in late February and March. How are you advising investors at this time if they're looking to put some money in and take advantage of the downturn?
So I think the recovery, as we've seen, typically comes in bursts over a small number of trading days. So I think the worst thing you can do during times like this is be out of the market completely. I know some investors can't handle downturns or they just panic sell, and I think that's the worst thing you could do. Secondly, I think this is a very different market than what we had last year. Last year, you could have really owned anything and you would have done well. Now we're into a market where you really have to pick your spots. And if you don't have the skill on your own to pick stocks, I think you should look to work with a qualified advisor or a firm that you trust where you like their approach, because this is a much more difficult market as we get into 2025. But we're seeing tons of opportunities, so you need to be able to take advantage of those.
And you just need to have the stomach for it.
Absolutely.
Got it. All right. Jordan, thanks for coming in. Appreciate your time. We'll see you again soon.
Thanks for having me.
That does it for us on Market Call. Let's have a quick look at the markets as we head to a break. We'll see you again tomorrow.